Hello guys, so this is going to be a video about bond yield. Okay, so we've kind of introduced this concept in previous videos about bond price. We talked about the alternative interest rate which we could invest our money in when we're deciding on whether to invest in this bond on the secondary market or primary market. And we're just going to build on those concepts and really kind of talk in more depth about yield to maturity. Current yield, which is actually probably the simpler version of yield. Going to work through some examples, hopefully as usual, just to kind of make the point crystal clear. Okay, so let's get started. So if you remember, in the last video, we sort of went over the formula for calculating a bond price, and we actually complicated it slightly to include the complication that we might get this bond might pay its coupon every 6 months, whereas our yield is normally expressed as an annual return. Okay, so basically the formula that we just to recap to calculate the fair price for the bond is given by the annual coupon payment, right? The actual amount of money that the bond is paying out per year, divided by f, the number of actual payments during the year. So if it's semi-annual and the annual coupon is 1,000, then C over F would be 500. So 500 pay out every 6 months. And then the rest of this formula, I over F is basically so I is your alternative interest rate in equivalent other investments of the comparable risk. So for example, if I'm considering whether to invest in this bond, I'm comparing the return I get from this bond against other investments in the marketplace that have a similar risk profile, right? I'm not going to compare it with with a junk bond that's likely to actually default. So I'm going to basically, I'm often going to compare this with a risk-free rate, for example, to say, well, okay, what's my alternative if I just invest this in a bank account that pays interest rate of I, okay? And then we divide that alternative interest rate by F on the bottom here, and we do the same on here, and then N times F is the total number of payments that we expect on this bond over the remaining lifetime, and M is the amount of principal, the outstanding balance, right? So just a quick, that's just a quick sort of recap. Now, on the subject of on the subject of yield, so there are two types of yield on a bond that I want to discuss in today's video. Okay, and the first one is called current yield. So the current yield is fairly straightforward concept, and it's kind of similar to how you might have heard the use of the word yield in any other type of investment. So the current yield is essentially what is your annual income, so because it's normally expressed as an annual basis, divided by the capital that's held up, the capital that's tied up in the investment, right? So if, for example, people might talk about rental yields, right? The buy-to-let landlords, right, that they might look at certain areas and say, okay, well, what's the rental yield in this area? And that would typically be the annual income, right, the annual rental income divided by the property price, right? And the key thing is that it's not the amount they paid for the property. It is the current market value, right? So this rental yield can go up and down, right, depending on how house prices are. So and there are two components to it. If the price of the property doubles, then the rental yield actually goes down, right? So even though you could say it's good for the landlord, if the property price goes up, his rental yield will actually go down unless the annual income also goes up by a proportionate amount. Okay, and the effect of that would be that the landlord, which often happens in areas where prices do go up massively, a lot of the time landlords will sell, and they will look for alternative areas to reinvest that money where this rental yield is actually better, right? Where they can actually get more annual income per unit of capital that they have tied up, right? So that's the sort of introduction to the concept of current yield. Now, in the world of bonds, it's a very similar concept, right? So the bond current yield is equal to the annual coupon divided by the current price, right? So let's just basically, let's just give a very quick example there, and then we can move on to the more interesting stuff. So let's say our bond Okay, so we have a bond and it has an outstanding balance of £1,000,000, okay, and an annual coupon, so the coupon of, let's say, 10%, so let's say £100,000 annually, okay, and let's say the current price of that bond in the marketplace is trading at a discount, meaning that the current market price is actually less than the outstanding balance. So let's say the price is £958,000. So if I wanted to buy this bond off one of these dealers, I would need to pay £958,000 in order to receive $100,000 per year in coupon and $1 million at the end of the lifetime. And let's just say, for completeness, that n years to maturity, although it doesn't affect this particular calculation, is 10 years. Right? So the current yield is simply the annual coupon, which is 100,000, divided by the current price, which is 958,000. Okay, which is 10.4% approximately. So one thing to notice here is that so when the bond was first issued, bonds are often issued at par, meaning the initial price is 100% of the face value. So let's say the initial price for this bond was $1 million, right? Then the current yield at the beginning would have been exactly 10%, right? Which is equal to the coupon rate, right? But since the price has now gone down, right? The price is now 958,000. The price has gone down, so the yield, the current yield, has gone up from 10% to 10.4%. So what that means is, if I want to spend my £958,000 tying up that amount of money, the annual income that I'm going to get as a percentage of that is 10.4%. Now, there's a limitation to current yield, okay, and that limitation is as follows. So current yield basically it doesn't take into account the fact that even though the price is currently 958, I'm actually going to get 1 million back, right? So we need a slightly more accurate way to reflect what will be my return on this bond if I buy it and then hold it all the way till the end, till I get the principal back and I collect all the coupon payments between now and then, right? And also get the principal back in, we said, 10 years, right? Maturity is 10 years. So 10 years from now, if I hold this bond to maturity, what's my yield to maturity going to be? Take into account all those cash flows. So we're going to go back to our formula for calculating the price of a bond, because this is what drives the yield. And it's very important to understand that the yield and the price are sort of interchangeably related. And so we're going to look at the formula again, right? So this was the price of our bond if we know what our required yield is going to be, right? So it depends which way around you want to think of it. So you might say, well, I know that I'm only interested in buying this bond for a price that gives me a yield of 7%. In which case you plug the number 7 into the value of I here, and then plug in the value of the annual coupon and the principal payment, and that gives you the price that you'd be willing to pay as an absolute maximum, okay? And any price that pays lower than that will then solve in the other direction to give you a value of I, which is actually higher than 7%, which obviously you'd be happy with. So, in a nutshell, the yield to maturity is the interest rate, I, which when you plug it into this formula, so basically, which is a discounting formula, it's the formula to discount all of the coupon payments, C, and the principal payment at the end. It's the value of I, where the present value of all of these cash flows, which is this formula here, equals the bond price, right? So take a moment to digest what that means. But effectively, what it means is, so it can go either way. So if somebody says to me, right, okay, so the bond that we talked about just 2 minutes ago, somebody says to me, well, okay, so the yield, so the current price is £958,000, right? And M, we said, was £1 million, and C was £100,000, right? So every year the bond pays out £100,000, and let's assume that the bond is paying annually, right? Just to keep it a bit simple, because we're just looking at the core concept. So basically, what you would do is you would say, well, okay, somebody's offering me this price for this bond. I need to find out what value of I gives this number when I use this value of C and this value of M. Because I, as an investor, I somehow believe that I have a desired yield that I think I can get elsewhere in other investments. And unless the yield on this instrument is better, I'm not going to be interested in buying this bond for this price. Okay? So let's actually have a look at what value of I we would need to actually achieve a price of 958. Okay? So there's actually quite a handy calculator that I'll put a link below to over here. Okay? And so it allows me to plug in these exact same numbers, right? So if I enter the par value of 1 million and I say the market value is 958,000, the annual coupon rate is 10% and the maturity is 10 years, right? So there are 10 remaining years, 10 remaining coupon payments, and then 10 years before you get that beautiful 1 million back from the bond, right? So if I just hit calculate on that, it gives me a very simple answer, right, of, so YTM equals 10.7%. So that's the value of I when I plug it into that formula, and you're welcome to try it out, I can't be bothered, which gives you a price of 958,000. If you thought that your best alternative investment right now was, let's say, so alternate rate for comparable risk, etc., etc. So the other investments that you would consider instead of this one, if the yield or the interest rate of those the best instrument alternative was, say, 10.5%, then actually this price would be an attractive proposition for you, right? You might even be able to pay a bit more if they said, actually, no, hold on, I've got another buyer who wants to buy it. You might be able to afford a bit more. In fact, you could even say that as long as the price gives you a yield of 10.5, then that's the threshold at which you're prepared to buy the bond. So if we actually look into that and say, well, if we increase the price slightly and say, okay, so 970,000, calculate. So there we go, potluck there. So it turns out that if the price is exactly 970,000, that means that the alternative interest rate of 10.5 is exactly the same rate as we will get if we buy this bond at that price and then hold the bond to maturity. So there's one key assumption that is built in there, which is that, so let's say we have our alternative bank account, right, which is basically what we'd be doing with this money if we don't buy the bond, and it's 10.5%. So if we think about the cash flows that we're going to get, so we said there were 10 years remaining, so 1, 2, 3, 4, 5, 6, 7, 8, 9, 10 coupon payments, all of £100,000 each. So we have 10 coupon payments, each 100,000, and at the end of it, we're also going to get our £1 million face value back. Now, so if we pay £970,000 as a price for this bond, so we will get, what we're saying is we will get basically exactly the same return if we take that same amount of money, okay, and put it in this bank account at 10.5% for those 10 years, okay. The return will be exactly the same as if we buy the bond for 970,000 and then wait for each cash flow to arrive, okay, and as each cash flow arrives, we invest that cash flow into the same bank account and keep it until the end of the period, right? So when we get the first cash flow after 1 year, we have to take that cash that we've been paid and we invest it at the alternative discount rate, at the yield to maturity in our alternative bank account, we invest it for 9 years. And the same with the second cash flow that appears after 2 years, we in order to get the same return as 10.5%, we need to reinvest that second cash flow for 8 years, and so on and so on and so on, right? So what it means is basically that those two strategies, i.e. investing 970,000 at 10.5% and leaving it compounding for 10 years, gives you exactly the same return as buying the bond for 970,000 and then reinvesting each of the cash flows as they arrive at 10.5% at the yield to maturity in your alternative bank account, right? So that's probably a bit of a mouthful, but if you just take time to understand it, basically, so the yield to maturity is exactly that, right? What's my average yearly return by buying this bond, receiving the cash flows, and investing them at that same rate? Okay. I'm going to give you a quick example of that in a spreadsheet, and if you actually want to see the spreadsheet, let me know. If you want me to send you a copy, I'll put it on GitHub or something, or try and find a way to email you, because it's quite good to see the actual example working. So I've put together a little spreadsheet here, and I don't know if it may look a bit complicated at first, but I'll just run through exactly what's going on here, because it can actually help to see some examples. Okay, so in the top section is basically the statistics about the bond that we're interested in, right? So let's say, okay, let's put the numbers that we've been talking about already. So let's put 1 million here. Okay, let's just widen this a little bit. So outstanding balance of the bond is 1 million. Okay, and let's say the coupon as a percentage is basically 10%, right? So let's make it 0.1, right? So that's 100,000 per year, right? And let's say also, for the time being, that our required yield is also 10%. So again, required yield, meaning this is the yield that I require on this instrument, because this is what I can get elsewhere, and if this instrument gives less than that required yield, then I'm not interested. Okay, so let's start with that at 10% as well. So at the moment, that required yield is the same as the actual coupon rate that the bond is paying, which is also 10%. So if you remember, our current yield was basically different to the yield to maturity, and the current yield is the current price the current coupon divided by the current price, right? So basically, you can see the current yield is also the same as the coupon rate, and that is given, if you look at here, by B3 times B4 over B20, which is the outstanding balance multiplied by the coupon rate, which gives you the actual coupon payment, and then divided by the current divided by the price, which is down here. Okay, so that's the current yield. We'll go back to where this actual price comes from, right, in a second. And then you can see that these fields here are derived, so we'll come back to these in a second, right? Now the next section is the cash flows for the bond, right? So it's a very simple example, and we have 3 periods. So we're going to say that there are 3 years remaining on this bond. So we have year 1 in column B, year 2 in column C, and year 3 in column D, right? So outstanding balance, we're going to say, is basically 1 million on each time, right? And what we're going to say is that at the end of period 1, for example, row 11 is the end of the period interest payment. So at the end of the period 1, we're getting an interest payment of 100,000. At the end of period 2, we're getting an interest payment of also 100,000, and also at the end of period 3, right? Then we're saying there are no principal payments after periods 1 and 2, but at the end of period 3, remember there are 3 years remaining on the bond, so at the end of year 3, we're going to get a £1 million principal payment back, which is the repayment of the loan, which is the M part of this formula up here, right, over here. Right, so that's the 1 million that you're getting back, right? Now, so that's so the interest payments, principal payments. Then what we're saying is, so this calculation is basically, if I take the interest payment from that particular period and I reinvest that at the rate which is my yield to maturity, okay, what will that be worth at the time the bond matures, right? Because if you remember, we said that we're assuming in the yield to maturity calculations that we take each cash flow as it comes and we reinvest the cash flow that we've received, we reinvest it at that alternate rate, right? At the yield to maturity in a different bank account somewhere that has that same rate. And this is what it will be worth after the at the end of the bond life cycle. So, right, so that first coupon payment of 100,000, which we get at the end of year 1, at the end of year 3 will be worth 121,000. Okay, and you can do exactly the same for period 2, where we also get 100,000, and again we reinvest that 100,000 at the same rate, 10%, for 1 year, because we're getting it at the end of year 2, and we want to reinvest it until the end of the bond life cycle, which is only 1 year from that point onwards. So that is now going to be worth 110,000. Okay, and then obviously in year 3, the total payment we get is 110,000 because it's 1 million. Sorry, it's 1,100,000. My apologies. And that is basically, we don't reinvest that because we have received that at the end of the bond life cycle anyway. So there's no more time left to reinvest. Okay, then what we're saying is basically, if you remember, so now we say, okay, how do we price this bond, right? What is the fair price of this bond? We know that that our assessment of what the required yield should be, what the overall return should be, is 10%, right? So again, we work backwards from the cash flows and we say, if our discount rate is 10%, in other words, if we can get 10% elsewhere for our money, then each cash flow has to be discounted back to the present at that rate in order to find out how much each cash flow is worth in today's money, right? Because when you price the bond, you're literally saying, look at all the cash flows that the bond is expected to pay me and determine on an individual basis how much it's worth paying for each of those, and then just adding them all up, and that's the amount that you want to pay, or that you're willing to pay for the overall bond today, okay? So what we do is we basically just, using our discount rates, discount factor formula from the previous video, which is basically, if you remember, PV equals present value is future value divided by 1 plus I to the power n. Yeah, so we're saying we're going to receive £100,000 for the first period in 1 year's time, 1 year from now, right? So what's that worth? What's that privilege of receiving 100,000 in 1 year's time? What's that worth to me now? Given that whatever money I spend to buy that privilege, I could be investing elsewhere at this rate here, which is my required yield, which is 10%, right? So this one is simply a case of, again, so going back to our formula, present value is the future value divided by 1 plus I to the power n. So plug in the numbers. So the future value of all these cash flows is basically the same, apart from the last one. So it's basically £100,000 of interest, okay? And we're saying for the first one, for the first period, right? First period, 100,000 divided by 1 plus I is 10%, right? So 1 plus 0.1 to the power 1. Because it's 1 year, right? The cash flow 1 is happening 1 year from now. So that comes out as 90,909, something like that, right? Then we do exactly the same for the second one. So if our alternative interest rate that we can get elsewhere in the market is 10%, then we're saying if we can buy the privilege to receive this cash flow of 100,000 in 1 year's time for this amount or less, then it's worth doing, right? And we do that for every single cash flow. Obviously, we can't buy the cash flow separately, but we add up the present value of all the cash flows. So if we do it for the second one, so the present value 2 is also 100,000, right? 100,000 of interest divided by 1 plus 0.1 to the power 2, because it's 2 years. 2 years from now, right? We're receiving that second interest payment 2 years from now. And then PV3, so the cash flow that we receive after 3 years is different, right? Because we're getting the principal as well. So the total cash flow we're getting is 1,100,000, right? And we divide, and the discount factor is 1 over 0.1 to the power 3, right? Because that's 3 years. So these are the cash flows we're getting, and these present values are basically what, in today's money, it's worth to pay for those cash flows. Anything that at that price or less, it's worth our while, right? So if we add those together, right, PV1, 2, 3, like this, right, then we have our upfront present value, so down here, right? I'll just highlight these cells. So basically you can see this is just a sum of B16 to D16, right? Like this. And you can see that the upfront, so the total PV comes out at exactly 1 million. Well, okay, so that's very interesting. And the reason that is because this is very important. When the yield to maturity, right, when the discount factor equals the coupon, right, then the price equals par. And price equals par means that the price, the upfront payment, is absolutely equal to the outstanding balance, right? The outstanding balance is 1 million, and we've calculated that the sum of the present value of these cash flows is exactly the same as the actual outstanding balance on the bond, right? So let's take a simple example, right? And let's say that when this bond is first issued in the marketplace, right? And let's say there are only 3 years. So this, Rolls-Royce issue this bond, and they want to borrow the money for 3 years. So they issue the bond and they want to borrow £1 million, right? It's not a lot of money. It would be much more than that in the real world, but they want to borrow £1 million and over 3 years. So let's say the initial price, let's say that the coupon that they set is basically 10%. So the coupon, as you can see over here, is 10%. And let's say also that in the wider marketplace in general, the prevailing interest rates for comparable investments are also around 10% as well, right? So the required yield to maturity is also 10%. So what that means is that when that bond is first issued on the primary market, to the initial investors, the price will be something around £1 million, right? And when the price equals the face value, that means the price is called par, right? That's what par means, right? So that's fine. So the bond is issued at a time when prevailing interest rates are 10%, and they set the coupon to basically say, well, yeah, we'll set the coupon at the prevailing market interest rates. Now let's say a few years down the line, let's say later on, there's only 3 years, but let's say interest rates were slightly different. So let's say the prevailing market interest rates had gone up to 20%, right? So if I was an investor trying to buy this bond on the secondary market, right, I've got some money to invest, right, and I'm wondering what to do with it, and I know that I can basically go out into the market and get 20% return annually on my investment without buying this bond, right? I can do alternative things and get 20%. So I would say now, okay, well, my required yield is now not 10%, it's 20%, right? So unless buying this bond gives me an overall return of 20%, if I hold it to maturity, I'm not going to buy it, right? So what has this done to the Excel spreadsheet, right? So we've entered not 20% as the required yield. The outstanding balance is the same. The coupon is obviously the same. The coupon is fixed at the time that the bond is first issued, right? That will never change. The current yield, now you can see that the current yield has actually gone up, and that's because the price of the bond has gone down, right? The price of this bond has gone down, and this is really important. You see this all over the place, and sometimes people find it unintuitive, but in the bond markets, right, when interest rates go up, and what I mean by interest rates is the prevailing market interest rates, not the interest rate of the bond, right? The interest rate of the bond stays the same, but the interest rate in the outside market, which is available for investors as an alternative, as that goes up, then the price goes down, right? And that's really important, and vice versa. So if interest rates go down, then the price goes up, and this will kind of explain exactly why, right? Because what's happened here is we've now said, right, so if we look at the cash flows are exactly the same, right? Because the coupon never changes. The coupon is basically it's 100,000 per year, right? But the question is now the discount rate that we're using to determine what the present value of those coupon payments is now changed, right? So now we're saying that if you look at the present values now, right, we're now saying that the present value in today's money of receiving £100,000 1 year from now is now only 83,333, and so what we're saying is if I invest 83,333 for 1 year, right, at 20%, then I will receive then that will be worth 100,000 at the end of that 1 year. So that's equivalent to basically what I'm going to receive in this bond, right? So this individual cash flow, I'm paying this. I'm repeating myself, I know, but play it on double speed or whatever. I just want to make sure it's clear. Same with the second cash flow, right? We're discounting by a much higher rate because our alternative interest rate elsewhere, our opportunity cost for tying our money up in this bond is greater now than it was before. So the present value has now dropped, right? And then if you look at the sum of these together, okay, the sum of these together now comes to this. It's basically it's 789,351, right? So the price, and that's where that number comes from. So the price has gone down. So let me just quickly change these numbers. Watch the cell in B6, right? When I change the yield, the required yield, so basically the prevailing market interest rates, when I change that back down to 10%, watch how this number goes up again, right? Just watch it. Right? So basically when the yield is the same as the coupon, the price is basically exactly the same as the outstanding balance, right? If the yield goes up to 0.15, right, then you'll see it go down to 885,000, right? And if the yield goes up to 20%, then the price goes down to 789,000. So hopefully you can see that's exactly why when interest rates go up, the price goes down, right? Because when interest rates go up, this particular bond, whose coupon is being fixed, is now less attractive to me because I can go out and lend my money elsewhere in the market and get a better return than what this bond is actually paying me, because this bond is only paying me 10% basically, right? So the price has to move in order to compensate for that. So that's that little example there. So I hope that's kind of illustrated the relationships between price and yield. So there's an inverse correlation there between price and yield. This is an example of an actual breakdown, very granular, and it does help a lot to play around with these things. So if you do want me to send you to make available a copy of this spreadsheet, then just let me know, and I'll be more than happy to find a way to publish it somewhere. And that's really it. So that's what yield to maturity is. Yield to maturity is the discount rate that we apply to all of the cash flows that the bond is going to pay out, which sets the present value of all those cash flows equal to the price. And we can work in both directions. We can say, okay, for this price, what is the yield? Or we can say, for this yield, what is the price? Okay. So in the next video, I'm going to start talking about LIBOR rates, because we've talked about fixed rate bonds a lot. There are other types of bonds where the interest rate, let's say the coupon that gets paid out every month, rather than being a fixed amount like 100,000, like 10% of the face value, we can have bonds where that interest rate, that coupon payment, actually fluctuates and floats with some underlying reference rate. Those are called floating rate bonds. And obviously LIBOR in itself is a very interesting topic, and it's been in the news a lot. So I definitely want to do some videos on that, explaining exactly who sets it, how it's used, and how it applies to the world of bonds. So thank you.